Hello everybody, welcome to the first sharpening session of this year, I believe. So my name's Becky, my email address is there, becky@traddictiv.com. I know you might have to do this a little bit to see it, but hopefully that's easy enough to remember, becky@traddictiv.com. So if you have questions as I go through what I go through today, if it doesn't make sense or you want to clarify anything, just email me, becky@traddictiv.com, and I can help you. What I also prefer you guys to do actually, rather than email me, and you can email me, is to use this link here, tradewithufos.com/Becky. So the reason for that, let's just bring that up. Reason for that is that if you go to that link, you'll come up with this page. About halfway down the page, there's a question and answer section. If you sign up for a free membership at the top, and you literally just put in your name and email address and follow the steps, if you sign up for a free membership, then you have access to the question and answer section. Why do I prefer you to do this? Because then you can ask a question in a public environment where other people can see the answer. So let's say you have a question that somebody else has already asked, you can come down here and you can see what the answers have been. So it saves you emailing and then maybe waiting a day or so for a response when the answer might already be here. So if you do that yourself, again, you're helping others to be able to see what the answer is. So to me, it's just a good way for the entire community to all keep on top of what's going on and get their questions answered. If you don't feel comfortable asking it publicly, of course you can email me, but like I said, I prefer it on this link. So tradewithufos.com/Becky, get yourself a free membership, and then you can ask a question there in a public domain. Okay, so let's just go back to the slide here. So I just need to make sure we cover the disclaimers. So they are being highlighted there at the top. Of course, it's important that you guys read them. not just because of the legal side of things, but it is important that you guys understand that whatever we cover in these sessions, whether it's sharpening, whether it's futures, stocks, options, whatever it is that we do, we are showing you a demonstration of how to use things and sort of talking through the methodology that we use. That's not to say that you have to copy it or that you have to do it. As long as it fits your trade plan, that's the most important thing. So as you'll see, our topic for today is questions and answers. Now, a lot of the time, people don't necessarily have any specific questions, so I do have a topic that I will be going through unless you guys have other questions. So let me know in the chat box there, on YouTube or wherever you're watching this. Let me know on the chat box what you would like me to cover if you have a specific question. Otherwise, I had a plan that I would be going through why we make a decision, why we buy, why we sell, why we do nothing. What is the importance of each of those decisions? Why do we have to have something that's objective to answer that decision, and then show you what we use, which is a free app actually, by the way, to be able to help us make that decision. So that's what I was going to go through today, unless you guys have any other questions. So you let me know. I might start on that topic for now, and then again you guys can just let me know as we go through the session if there's something particular that you want to cover. So for me, just before we get started, I just want to make sure that we make this really clear. So question number one, trying to put it in a place where there's less noise on the screen there. So question number one, whenever we trade, is should we buy, sell, or do nothing? That's the first thing we should be asking ourselves. And it doesn't actually matter necessarily how you answer that question. There are loads of different ways to do that. People use Fibonacci's, people use breakouts, people use chart patterns, people use different apps and technology or fundamentals to help them make this decision. And it doesn't necessarily matter which. What's important thing is that you can answer this question. If we're looking at something and we're kind of making it up as we go along, whether or not we buy, whether or not we sell, whether or not we leave it to do its thing, and we just change our methodology all the time, and we change what we're doing all the time, we're not very likely to be able to do very well in the markets. It's okay to do nothing. Most people think that when we're trading, we should be pressing buy, we should be pressing sell, we should be following what's going on, we should be with the trend, we should be, I don't know, against the trend at a particular area, we should go with support and resistance, and we should be pressing buy and sell all the time. If anything, I would say the majority of the time, we need to be in this category, just doing nothing. But how do we know that we should be doing nothing? And again, you need to have something, some form of methodology, some form of technology, something that answers this question. Again, why is that important? Because doing nothing suggests that you don't have probabilities for either buying or selling. When we're trading in the markets, we're risking time to go through and make our decisions and analyze things, and we're risking money. When we put trades on, unless obviously we're in a demo account and we're practicing, we are risking our hard-earned money. So why would we risk our money on something that doesn't have good enough probabilities one way or the other? Why would we press buy or sell if the likelihood is that it's going to fail? Better to have done nothing. Better to have maybe wasted a little bit of time doing some analysis to then figure out, no, there's nothing good here, there's no probabilities either side, or not enough probabilities either side, in which case I'm not going to do anything. Maybe it's not a particular area that I use on support and resistance. Maybe it's not a Fibonacci retracement. Maybe it's not trending in a particular way strong enough. Maybe there's not good fundamentals one way or the other. Maybe there's news coming out that could create volatility. Whatever it is that helps you make this decision, I would say the majority of the time this needs to be the answer. Doing nothing. Because the majority of the time you're not going to have all of the odds stacked in one side or the other. And then we're just risking real life money for the probability of it not going particularly well. So why would we do that? Why would we waste our money when we don't have to? Now, obviously when we're trading, we do want to be buying and selling. That's going to be the main thing we want to do. We're going to want to be in one of these two categories. Again, we need to be comfortable with this one. We need to be comfortable with doing nothing. But when it comes to buying and selling, how do you know? Sometimes it could be that a market is trending. Let's say a market is doing something like this, and we think it's trending up. I should be, let's change the color there, I should be buying here, or I should be buying here, or I should wait until it comes back here and I should buy it. Perhaps. But hey, how many times has a trend then changed? All the time. On any time frame, on any stock, on any futures contract, on any currency, trends change. Market conditions change. Markets are dynamic beasts. They move all the time. And again, so what we want to be able to do is to know, yeah, okay, should we be buying or selling based on probabilities? Yes, if a trend is going up, great, that's a good thing. We should probably follow that trend and get in with that. The trend is your friend. But you probably also heard, the trend is your friend until the bend at the end. It comes to an end. So again, we need to have something that lets us know, do we have probabilities of this continuing to happen? And therefore, is it worth my money? Is it worth the risk for me to buy? Buying right at the top there, bad idea. Buying here or here, somewhere into the start of that trend, good idea. How do we know that? Again, we don't know anything in the markets. It's just all about probabilities, stacking things in our favor, and having some form of methodology that helps us make sure we have probabilities if we're going to buy or sell. Not only that that's the best thing to do, but that we have lasting effects of that. If we're going to buy, we want the market to keep going up. If we're going to sell, we want the market to keep coming down. So again, we need to have probabilities that that's likely to happen after we buy or sell. Again, based on whatever methodology you want to do, as long as it's clear and it's consistent. So for us, we use a free app. I'm just going to bring it up here. There we go. So I'm going to show you on TradingView first. My mouse gone a bit weird there. There you go. I'll show you on TradingView first, and you guys let me know on the chat box if you've done TradingView before, if you've used TradingView before, or if you use TradeStation, or different platforms, different technologies that you might use. I think both TradeStation and TradingView are relatively easy to use. TradeStation is a little bit more complex, but you can use sort of basic implementation of it. And either way, it's going to look roughly like this when it comes to the apps that we use. So I'm just going to take off my UFOs for now, just so we focus on this bit at the bottom. So the Auto Climate app, which is this bit at the bottom, and by the way, to get the app, just again fill in a free membership and go through from there, and then you can choose to download the app for free. So on TradingView there is an $8 activation fee, but if you email us, then again we can help you with that and help you get that all sorted out. But the app itself is a free app. So what does this app do? It's called Auto Climate. It is scanning the markets for a whole bunch of data. It's looking at all kinds of things. It's looking at moving averages, it's looking at chart patterns, it's looking at prices, it's looking at how quickly things are moving, it's looking at how far away it is from certain things. What this is doing is analysing the data for us, analysing the markets for us, and coming back and saying to us, good idea to buy, good idea to sell, or good idea to do nothing. For me, what I like about this, and as I've said, you can use different methodologies to help you make decisions, as long as you have something that helps you make a decision and that it's consistent. For me, what I like about using technology, in whatever form you want to use, is that it does a lot of the thinking for me. I don't have to get confused. It either is or it isn't. So in the case of AutoUFOs, you'll see down here we have these thick blue dots that's more recent. We also have further back, we've got some thick red dots, and you'll also see, if I use a different colour to highlight these, we've got some thin dots of either colour as well. Ignore the lines for now, I'll get to that in a minute. But if we're looking at just the dots and the thickness and the colour, these dots are telling us good idea to buy, good idea to sell, good idea to do nothing. Which means I don't have to be looking at chart patterns. Did it break this? Okay, it broke that on that time frame, but that not on that time frame, and it broke that pivot, but not that pivot, and it's been going up for this many candles, and I don't need to do any of that. This does it for me, and it comes back and it gives me the answer. Look to buy, look to sell, look to do nothing. Now, I need to be clear here. Yes, this is helping us answer question number 1, but just because it might say good idea to buy, for example, does not mean we just go and press buy at whatever the price is now. There are obviously further steps to a methodology to make sure that we can keep our risk managed, that we can increase our profitability, that we can be probable, that we have probability on our side as well. So yes, this is question number 1, but there are further questions to come. But if you don't answer question number 1 first, how do you even know what you're doing? So again, this is why this is helpful. So for those that might not have seen Auto Climate before, you might want a little bit of a refresh on it. Auto Climate, when it's showing us a thick blue dot like we see here, I'm pointing to with my arrow there, a thick blue dot is telling us that there is a confirmed upwards climate or upwards trend, meaning probability to the upside. So if you just look at the thickness of the dot and the colour of the dot, good idea to look to go long. You can then go and do whatever else you do, whatever other methodologies you use, whatever other technologies you use to help you decide where you're going to buy. but at least you know that you should be looking to buy, and that's what AutoClimate is helping us do. When it's a thick red dot, which is this one here, a thick red dot is telling us that there would be probabilities to the downside. So a confirmed downwards climate, confirmed downwards trend, we should be looking to sell. And again, just because it tells us that we should be looking to sell doesn't mean we just go and press sell at whatever the price is now. Again, you're going to have a structure in place to help you figure out where to sell. But at least the AutoClimate app is doing the analysis for you and telling you you should be looking to sell. And then you know what you need to do in your own methodology from there. Now, if we have a thin dot of either colour, like we have here, so you might not be able to see the colours very well, so I'll just highlight it in many ways so it's coming up there. So the thin dot of either colour tells us that there are not enough probabilities either way. So ignore the colour. When it's a thin dot, it doesn't really matter what the colour is. It's just telling us lack of probability. If we have a lack of probability one way or the other, why would we risk our money? Why would we place our trades? Why would we go any further in a methodology and take more time to place a trade that doesn't have probabilities on its side? So again, if it's a thin dot, that's telling us do nothing. Thick blue dot, look to go long. Thick red dot, look to go short. That's on the surface. If you just look at the thickness and the colours of the dots, a very easy way to help answer that question number one. I'm just going to look there to the chat box. So it raised the audio volume level. My audio should be fine. In fact, my mic's on full. Like full volume. So perhaps maybe try on your computer or try on your phone if you're on your phone. See if that works. Actually, it might be really helpful if the others that are watching live at the moment, just let me know if you're having audio problems as well. Maybe something I can do with my mic, but it should be on full volume at the moment. But you guys let me know in the chat box so I can see if it's something I need to do my end. So I can talk louder as well. So sorry for you guys if you do have good audio and I'm now shouting at you, but I'll speak a bit louder so we've got it. Okay, so we've already answered the question, should we be long? Should we be short? Should we do nothing? That's just a very easy way to answer question number one. But remember we said, and like we see here, markets that go up for a long time are less likely to keep going up and more likely to change direction. Why is that? It's almost like physics. You pull an elastic band and you just keep pulling, keep pulling, keep pulling, keep pulling. The more you pull it, the less likely it is to help you keep pulling it or to let you keep pulling it. And the more likely it is to contract on itself. The way markets move is buy orders and sell orders. The more buyers you have versus sell orders, price goes up. The more sell orders you have versus buyers, price goes down. There is a finite amount of things to buy and sell. So nothing can keep going up and up and up and up and up forever, nor can something keep going down and down and down and down forever. It's going to have to get to zero and then not be tradable, right? So there are no guarantees that just because something's going up means it's going to keep going up. In fact, if anything, the longer it keeps going up, the more we should be thinking, this is probably likely to come down. But again, we want to do this based on probabilities and statistics that tell us when it's likely to come down or whether or not we still have probabilities to be able to get in and ride that move to the upside. Because of course, I'm sure you guys would agree with me, we'd have rather got into this uptrend there or there rather than up here, because you've got objectively more space here to make money. Buy low, sell high, that makes sense. So the lowest we can buy into the start of a trend, the better, because we have more time for it to continue to go to the upside and make us more money. There's more space to the upside. If we were going short, let's just draw this. Let's say we had a trend like that. We'd want to sell up here because we have objectively more room to make money to the downside. So yes, we want to follow what AutoClimate or trends or whatever it is telling us is a good idea to do. And at the moment, we still have probability to the upside. But do we have probability that it continues to go that way? That's something that we need to layer into this as well. And again, this is all on the AutoClimate app, collecting the data for you and telling you where the probabilities lie. So you'll see on here, I've just highlighted there, we've got an up arrow and then SDT, so standard up, and then SDT down, and then the current. So this first bit, if I use a different color to sort of highlight, this first bit here is AutoClimate, again, running through all of the data and telling us as an amount of candles. So depending on the time frame that we're using, this is a weekly time frame. Depending on the time frame that we're using, in this case, we've got 10.42 candles, so 10.42 weeks. By the way, whatever the decimal place is, we're always going to round that up because, of course, you can't have like a percentage of a candle. So we're always going to round it up. So let's say 11. So 10.42, round that up to 11. So 11 candles on a weekly chart is how often this market, which happens to be Apple, goes upwards for before it changes direction. That's not to say it goes up for 11 every time and then it comes down, and then it goes up for 11 every time and then it comes down. It's just these statistics, it's just the probabilities. Of course, it might go to 12. In this case, we're actually currently on 14 to the upside. This next bit, let's use green. Probably should have used green for up and red for down, but you get my point. This bit in the middle here, this next section that we have here on the stats is telling us how often this market comes down for, or how long it normally comes down for. So again, that's 3.57. Let's round that up to 4. What that's saying is Apple on a weekly chart will come down for 4 candles averagely before it then changes direction and goes back up again. So why do we need that information? Why is that important? Because we can then compare that to how long we've already been going in that direction to then figure out if we still have room to go to the upside. Now, before I explain that, I'm just going to come back to the chat box and see how we're doing with sound. Okay, sound good there. PC volume all the way up. It's fine. Sound is clear, no problem. Okay, cool. So I'm not sure what it is there on sound. It looks like we've got good sound for some people, we have bad sound for 1 or 2 of you. Hopefully, I'll come a little bit closer to the mic and I'll shout a bit more. Hopefully that will be helpful for those of you that do have good sound and just turn me down a little bit. Okay, so in this case, we see that in this particular market, which is Apple on a weekly chart, and again, I'm using data from TradeStation here as well, it goes up for 11 candles normally before it changes direction. So based on probabilities, we can expect a movement to the upside for about 11 weeks on a weekly chart. We are currently 10 candles to the upside. What that tells us is we've already surpassed what is normal in this market. Now, that's not to say, of course, things happen outside of the norm. Statistics and anything don't tell you something is 100% going to happen. It just tells you that there is a higher probability of something happening. So if we've gone past the probabilities of a move to the upside, then it's unlikely that it will continue for another 5, 10, 14 candles. If we want to get into a trade, we want to make sure that we get in sooner into a trend so that we have it to continue to the upside and get to its usual move to the upside or maybe surpass it. So in this case, yes, although we have a thick blue dot that's telling us there's probability to the upside, and there is, we also have to factor in, is there probability that it continues for another, if we're on a weekly chart, another week or 2 or 3? And the likelihood here is probably not. Now again, these kind of things come down to your personality. So risk and how you feel about risk and when you want to put trades on and the probabilities that you need versus the risk that you have versus the profitability that you want, all of those things are subjective. Meaning, any part of a methodology, any technology, any use of something, you have to understand your own thought process and the way you feel about stuff first. Because there might be some people that want to be very, very strict because they care more about probability, and they'll say, I'm not going to get into a trade once it's gone past 11. Not at all. Now, bear in mind, statistics are made up from some things that do go past that, some things that come below that, and it gives you that average in between and what's probable in between. But you might say, no, if the statistics are saying me 11 candles in a row and I'm on candle number 11, nope, not looking at it, move to the next one. That would be a stricter way of doing it. You might be someone that's even stricter and says it has to be half of that for me to get into a trade. You might be somebody that's a little bit more lax and says, well, sometimes these things go further and I have a real big boom to the upside, so I will get into a trade if it's gone past the probabilities, but maybe I reduce my risk a little bit. Or maybe I'm okay if it goes up to 50% more. Whatever it is, the most important thing is that you're strict and you're consistent. So if you're more risk averse and you want to say, no, I'm only going to get into a trade where I have half of the statistics. So if it goes up for 11 candles, I need this number to say 5 or 6. And if it's over that, I don't get into the trade, then be consistent on that. Don't have that rule sometimes and then change a rule another time. Have that rule all the time. If you're somebody that says, no, it's okay because I'm only looking for small movements, or as long as I hit one-to-ones, I'm okay, or whatever your other methodology says and the way you think dictates, you might say, if this is 11, I'm okay to get into a trade to the upside, anything up to 16, anything up to 15, anything up to, again, whatever number. But keep that rule. If it's 50% extra on top, if it's 20%, if it's 100%, keep that rule, be consistent. If you change your rule all the time, you won't know what's working for you and what's not. And it's just data collection. The more you practice the same rule over and over again, the more you can see whether or not it works for you. So when it says current is 14, that means it includes both the candles up and down. No, good question. So this means literally 14 candles to the upside. Now the reason it says the upside, I'm just going to get rid of my arrows here, is because we have a thick blue dot. So AutoClimate knows we have a thick blue dot and is saying we are currently 14 into this movement, which is to the upside. You'd notice, let's say we start to have movement like this, we probably then start to have little dots there, and then maybe a thick red dot would happen, and then current would say 1, because it would then be saying you are 1 candle into the downside. So the current is about what's happening right now based on the trend or based on the climate that exists right now. So right now this is 14 candles to the upside. That's what it's looking at there. So good question. Okay. So again, we have the auto climate to just tell us one way or the other, look to buy, look to sell. And you can be somebody that is even less risk averse and just wants to be in more trades and go, I'm not even going to look at the statistics. I'm just going to go straight for the thickness and the color of the dot. Thick blue, I'm going to look to buy. Thick red, I'm going to look to sell. And you could leave it like that. Understand, and this is true not just of AutoClimate, but of every single app or every single methodology that you use. The stricter you are, the less trades you have. You're going to have less opportunities that fit multiple different variables. Now, that means that you usually would have higher probabilities because you get into less trades, but they have more things they have to hit, meaning they're more likely to go in your favor. But it might mean that you end up with a trade a week, 2 trades a week. If you're using very small time frames, maybe a trade a day, 2 trades a day. If you are somebody that says, I just want to be trading, I just want to be in the markets, I don't want to lose money overall, but as long as I have enough probabilities to take a trade, I don't care so much if more of my trades lose, because I'd still win overall if I'm right 40% of the time, 50% of the time, 60% of the time. So I'm okay to take more trades knowing that a higher percentage of my trades will be losers, but I'm taking more trades, I'm more busy, I'm more focused on what I'm doing. And as long as overall I win, I don't care if my probability rate is a little bit less. Neither approach is right or wrong. You've got to do what makes most sense to you. If you force yourself to be risk averse when you're not, you will break your rules all the time. If you force yourself to place trades and just roll with the punches when you're more scared about that or nervous about that, again, you're going to want to quit or something like that. So you have to go with a way that makes you feel more comfortable with the way that you think, with the risk tolerance that you have. Again, just be consistent on that rule. So if you're looking at the dot, we see we have a confirmed probability to the upside, and we also see here that we have 14 out of usually 11 to the upside. So again, interpret that as you will, but the statistics, the great thing about this, the app has got the statistics for you. You don't have to go work that out. It's telling you. You interpret that in the way that you interpret that. For me, I probably wouldn't be getting into a trade at this point. It's too far for me. But again, you guys might have different thought processes there. Now, I'm just going to show you on TradeStation what this looks like. So again, it's a pretty similar thing. I'm just going to make this one bigger so we can see this one a bit more. Okay, so with TradeStation, if you're using TradeStation instead of TradingView, the app looks the same. So this is a weekly chart, daily chart of Apple. Let's go back to weekly there, so we see the same thing. There you go. So this is doing the exact same thing. You've got the exact same thick blue dots, thick red dots, thin dots of either color. You've got the exact same stats. Now, you might be thinking, you might have realized this, I've just realized this. This number is different than the one on TradingView. Why is that? It's to do with the amount of data that you load. So the app is analyzing all of the data that you have on that chart. So if I load 6 months worth of data, then it's going to say, based on the last 6 months, this is what the statistics show. If I load 6 years worth of data, then it's going to say, based on the last 6 years, this is what the statistics show. So again, it's about consistency. make sure that whether you use TradeStation, TradingView or both, that you're loading the same amount of data every time you look at that same chart. If it's a year, 2 years, 6 months, 3 months, whatever. Let's say you're on a weekly chart, you probably want a couple of years worth of data minimum. So make sure it's always a couple of years worth of data. Or you can be even more consistent. If I just double click on the price here, you'll see here a little window comes up. I can go to bars back and then 500, meaning it's going to load 500 candles worth. Whatever time frame I'm on, it's going to load 500 candles worth. So it's more consistent. And I could set that as default and click OK. And it will then load 500 candles worth. And again, you can do the same with TradingView to load different amounts of data. So again, as long as you're consistent with that, you've got the data that shows you that. Some of us might be thinking, well, the most recent data is the most important. What's happened in the last months is more important than what's happened as an average. Doesn't matter what consistently. You're not loading 500 bars one day and 100 bars another day and 2 years another day. Themselves, which means you choose the same amount of data that you load for every time you look at that same chart. So hopefully that makes sense. At the exact same thing here. It's doing the exact same job. It's coming back with, if you load the same amount of data, coming back with the same numbers. So whether you're using TradeStation or TradingView, both by the way are free apps. AutoClimate on either one is free. Then you're going to be able to use it in that way. Now coming back to hopefully we get the dots. You guys let me know if I've lost you at any point. But we get the dots, we get the stats. So again, it's just a representation of different data that it's collected. So what the lines are doing is essentially showing you how far price is to an average. How far is it from an ideal trading price? Now this is more relevant to actually later on in the methodology, where we're going to be getting into our specifics of our where we get in or out, where we buy, where we sell. But I won't go into that depth for today. That's a whole other session. But what these lines are saying to us is, if it's a long line, let's take this one here, then that's far away from an ideal trading price. The ideal trading price is around where we want to where we're look at the charts, do methodology, do your analysis, and realize that you're going to have to wait. This is a weekly chart. Which reduces your probabilities. So we want to be looking for, when we're going to then look on to the next step as to furthering into the methodology where we're going to buy or sell, we want to be ideally looking for these opportunities where we have short lines, where price is relatively close to an ideal trading price. If it's closer to an ideal trading price, it's more worth our time to go and spend the time right now to do the analysis and put the trade on, because we're more likely to get triggered into a trade where price is closer to it right now. So just looking there for this, so just saying hi to Jose. You can't update. Okay, good. Kind of a very quick summary. But again, even if you don't follow the rest of the methodology, this is showing us is whether or not it's worth your time to continue your methodology to get into a trade. The longer the line, the less likelihood it is that you're going to get triggered straight away. The shorter the line, the higher the probability that you'll get triggered into that trade straight away, and therefore more worth your time to spend the time planning and analysing the rest of your methodology now. So for example, when we had this area here, this was at this point. And again, this is where we combine these different elements of this area around this. If I was going to be buying this market, I would have quite liked to buy it here around the $70 mark, considering it's now $135. It's nearly doubled from May, April time. So I would have quite liked to get into it then. And what did we see there? We had a thick blue dot, which was this third blue dot. We had two thin ones, which was saying, not sure. And then we had a confirmation on that third day, which was, I believe, might be that one next to it, which was this candle here. There we go, this candle here. So getting in on this candle here at this thick blue dot, probability to the upside. Said, let's assume on that way. So you which would have been a great place to take a trade and follow this to the upside. I hope that's making sense, let me know. So, Becky, if we don't see a right climate on a weekly time frame, to go to a shorter time frame, or it depends completely on our trading plan, if we are intraday or swing or long term. Yes, so you've kind of answered the question there, so I'll just expand on that. Yes, it depends on your trade plan. Now, let's say you're looking at a weekly chart for your auto climate, monthly chart, you know, either up or down. It's not necessarily going to make a huge amount of difference, but if you're using monthly, then weekly, then daily, then 4 hour, then 30 minutes, then 55 minutes, then whatever, you know, changing it all the time, again, you're lacking consistency. So let's say you're a swing trader. If you're a swing position trader, then you might use a daily chart for your auto climate, and you might use a weekly chart for your auto climate. I would say don't use more than two. And if you're using, just write this on here, if you're using a weekly chart, then at least if you follow the Trade with UFOs methodology, the smaller time frame chart you're going to use is a 144 minute. If you're using a daily chart, then the smaller time frame chart you're going to use is a 55 minute. So it's okay to switch between these two because they're close to each other and they would sort of fit together in terms of style. What you don't want to be doing is looking at a weekly chart, and let's say you've got a thin dot, let's say that. There you go, let's say that's a thin dot. You've got a weekly chart that's got a thin dot, you go to a daily chart that's got a thin dot, and so therefore you go, right, I'm going to change timeframes until I see a thick. Probably if you were using these timeframes, you decided to use these timeframes for a reason, because you decided that swing trading suited you best. So the best thing to do, if you're looking at one or two different timeframes and you don't see the setup that you want, maybe you do have a thick dot, but you've gone way too far in the statistics. Maybe you do have a thick dot on good statistics, but the line is all the way up here, so it's probably not worth your time, or whatever. You don't see things line up the way you want it to line up. Look at a different market, I would say. So if it's stocks, instead of looking at Apple, look at Facebook. If it's Forex, instead of looking at the euro dollar, look at the pound dollar. Look at the euro yen. If it's futures, instead of looking at oil, look at natural gas. You know, change the market rather than change the time frame, so that you're sticking with the plan that suits you best. Cool. I think I just had a connection thing there. Hopefully I haven't lost you guys. You let me know. I think I've still got you. I just had a connection error, but hopefully you're still with me. So let me know if that answers the question. Essentially, yes, you are going to be sticking to your plan. Change market instead of time frame if you don't see what you want to see on the auto climate. You've got daily and weekly are relatively similar. Let's say you were a day trader, and let's say you're using the 60-minute chart, which then means you're using the 8-minute for a low time frame, I believe. If you're using the 60-minute chart, maybe you're using the 4-hour chart as well, which would be a 21-minute chart. So again, these two are not too different from each other, so you could use them to align with the same style, so that you've got two different opportunities there. But just make sure then that if you've changed this time frame, you also need to change your lower time frame to have that sync properly. So hopefully that makes sense. Okay, good. So We want to answer question number one. We want to make sure that we know, am I buying? Am I selling? Am I doing nothing? Just as a recap for those that might be joining us a bit later, or again, just to kind of explain it all again for you guys to make sure that we're definitely on board with this. Thin dots of either color, do nothing. And be okay with doing nothing. Like we just said, you could change to a different time frame that's close to the one that you were looking at initially. So let's say, for example, on this particular market, we've gone past our statistics. So we have a nice thick blue dot, but we've gone past the statistics to say that normally this market goes up for 11 candles. We're on candle number 14, meaning if we were to buy around about now, we don't have as much probability that it continues to the upside. And if we buy here, well, we want it to keep going up. We don't want it to change direction, and it's more likely to change direction than it is to keep going up. So let's say we go, okay, let's look at a daily chart instead. Wrong thing there. One day. Let's look at a daily chart instead. Now, what's interesting here on this daily chart is that we actually have a confirmed downwards climate here. So we have a thick red dot, probability to the downside. Now that actually kind of makes sense considering what we were saying about the weekly chart having gone over what is normal to the upside. On smaller timeframes, this market is starting a move to the downside. So it wouldn't be surprising if on the weekly chart, we start to see that change as well. Now, in this case, we have a thick red dot, meaning we should be looking to go short. We should be looking to sell this product. Again, that's not to say we just press sell. That's not to say that we just sell out of anything that we already own, or that we just go and sell a short at random at whatever the price is now. We never do that. There's still methodology to it. But when we look at the stats, let's have a look. Normally, on a daily chart, so again, we've changed time frames now. So the stats are looking at different candles, different price points. Normally on a daily chart, this market would go down for 4.49 candles. We're going to round that up to 5 candles. So go down for 5 candles, currently on candle number 3, meaning we do still have probability of a continuous move to the downside. So you could say the weekly's not quite lining up the way I want it to line up. Let's change to the daily. Great, okay, I actually have a short opportunity here. Or you might say, instead of Apple, let's look at Facebook. Or I'm just using those because they're well known, right? You could pick whatever. On Facebook, on a daily chart, we have thick blue dot, probability to the upside. Usually on a daily chart, Facebook would go up 7 candles. There's actually 7 on the dot, 7 candles in a row, and we're on candle number 3. So probability of a continuous move to the upside. Let's say, for example, this was a thin dot and you're looking at the daily and you think you're a swing position trader. You could then just change to the weekly and again, just change it that one over. And with this one, perhaps there's not enough data there for that to be loading. With this one, we have a thick blue dot, confirmed upwards climate. We're currently on candle number 1. For some reason, those statistics aren't loading there. It might not have enough data to do that. So again, let's say we look at, I don't know, Google. And again, I'm using stocks. It could be, this applies. What's beautiful about this is charts are charts are charts. Data is data is data. Markets move up, markets move down for different reasons all the time. All of them are going to have statistics as to how often they go up, how often they go down. All of them are going to have an auto climate application that we can use because it's just data. If we took away, and I'm going to cover it with my hand, I know you'll still be able to see it, but if you covered with your hand that we're looking at Google on a weekly chart, you wouldn't know that. Auto climate is just analysing the data objectively. It doesn't care what's going on in the news with Google. It doesn't care what's happening in the wider world. It doesn't have any subjective opinion whatsoever. It's just looking purely at data, statistics and probabilities, which then makes it easier for us to make objective decisions when we trade, rather than make decisions that might be a bit biased, shall we say. So in this example, and again this is a good example of where you have 2 things lining up but not everything. In this example, we have thick blue dot, confirmed probability to the upside, upwards climate. We have good statistics, because normally this market would go up, let's highlight this bit specifically, for 7 candles. It's 6.74, so I'm rounding up. Go up for 7 candles, and so far we've been going up for 3 candles, meaning I've got probability on a weekly chart of a continuous move to the upside for another 3-4 candles, maybe more. Now, that's not to say that will happen. It could change tomorrow. But we have probability on our side that it's likely to continue to the upside. So again, why would I risk money if I don't have probability on my side? Now, of course, I need to make very clear here, just because we can line up probabilities in our favour, never means we have a guarantee. We always need to manage our risk just in case we're wrong, and we have to accept in the markets we're going to be wrong. The markets will humble you quicker than anything else. It's okay to be wrong in the markets. It's expectable to be wrong in the markets. We need to manage our risk in such a way where it doesn't really matter so much if we are wrong a few times. If we're going to be trading, we want as many probabilities on our side as possible so that we have less likelihood of losing, but still manage our risk if we do. So we've got two things lining up here. Probabilities to the upside in the first place with our thick blue dot, probabilities that it continues to the upside, but what we don't have is a line that is favourable. This line is a reasonably high line. It's a whole other conversation to go into what it's analysing and why it is that way. But if we just accept for now, we can see from this line that current price is quite far away from an ideal trading price. If we want to be buying and selling at ideal trading prices, which of course is the best thing to do, to trade at ideal prices, then we could go to a different time frame now, go through our methodology, and then be waiting a few weeks to get into this trade. If we wait a few weeks to get into this trade, by the time we get into it, this has changed. Or perhaps the climate itself has changed. So kind of not worth our time. So in this case, we're going, price is too far away. Although I've got things in my favour, I'm just going to keep away from this market. I'm going to go and look at another one and see what lines up. So again, we could look at the same market, and I'm using swing position trading timeframes here. Of course, if you're using smaller timeframes on a daily chart, or and you're getting in and out within a day, you're an intraday trader, and you're using small time frame charts, 60 minutes, 8 minutes, 21 minutes, whatever, the exact same thing applies. It's just all condensed down into a smaller period of time. Now we've gone down to a daily chart here on Google, and again, we have statistics telling us normally this market goes up for 5.49 candles. Let's round that up to 6. We're currently on 9. Not too far now into this move to the upside. Again, you might be somebody that says, I'm okay to still take a trade if it's gone past this number. I'm just going to half my risk. So where I might usually risk 1% of my account, maybe I risk 0.5% of my account. You might be somebody that says, I'm going to risk the same amount on every trade and I don't look at the statistics at all. Fine. Again, bear in mind, the less things you have in your favour, the less probabilities you have in your favour, the more likely you are to have losing trades, but you're going to have more trades. So again, it's that balance. Let's say somebody places, I'm just going to do quick math here, just make this point, which hopefully will help you guys to figure out where you might sit on methodologies, not just AutoClimate, but anything else you use, as to how strict you are on what needs to line up. So let's say somebody is really strict and they take 10 trades in a month, 10 trades that suit their methodology, and 6 of them win and 4 of them lose. Let's just be minus less strict and they have less probabilities and they're taking a lot more trades, 100 trades they take. Now, they might only have 40% of their trades work and 60% of their trades don't work. So 40 trades win, 60 trades lose. So let's say for the 40 trades that they win, again they've made $20 each time, so that's $800, I think. And then you've got $60 or 60 trades minus $10, which would be minus $600. Now, this person on the right-hand side, and I'm not making a point for one way or the other, this person on the right-hand side, the person on the left made 80 bucks, the person on the right made 200 bucks. They placed 10 times more trades. So they're inefficient with their trading because they're placing a whole bunch more trades. They didn't make 10 times more money than the person on the left. They made one and a bit, or two times and a bit more money than the person on the left. My maths isn't great. Hopefully, I'm just trying to make the point as to how this works. So neither way is right or wrong. You might be somebody that says placing 100 trades in a week, month, year, that's a lot of work. I don't want to do that, and I don't want to be wrong 60% of the time. I can't handle being wrong more than I'm right. So you might be somebody that says, although overall I might make less money because I'm placing less trades, it's a more efficient use of my time, and I don't have to be wrong as often. So I'm more comfortable with that number. Neither one is right or wrong. It's just to show you, and hopefully it makes sense now as I go through and explain as to the different rules that we have in AutoClimate. The person that we saw there on the left might be much stricter and say it has to hit this and this and this, and it has to also hit my UFOs and my moving averages, and be a fib price, and be whatever. The more things they have, the less trades they take, but usually the higher the probability that they make money. The person on the right was an example of somebody that has less restrictions, less variables that need to add up, so they place a lot more trades, they're placing a lot more trades, still end up making more money, but they're going to have to be okay with being wrong more often than they're right. Again, but when it comes to you looking at AutoClimate, you'll know which side of that aisle you sit on, or whether or not you're somewhere in between. So therefore, you'll be able to figure out, am I somebody that is okay to take trades that have gone past statistical probability? Yes or no? Would I rather be right more often and place less trades, or right less often but have more trades? As long as I'm profitable either way, I'm okay. Again, that's up to you. You might be somebody that says, I don't look at the statistics, but I care about trading at an ideal price. You might be somebody that says, I have different rules as to what is an ideal price, so I'm going to ignore the lines. Again, either way is fine, as long as you're consistent on your approach every time, as long as the way you interpret whatever technology you use, whatever data you use, whatever apps you use, in the same way every time. For AutoClimate, it's doing a lot of the thought process for us. We don't have to get confused. We don't have to think about, should I buy, hold on, that crossed that line, but it didn't cross that line, and that time frame's different, whatever. It's literally just, is it thick blue or thick red? That's it. That helps us figure out, do we buy or sell? And then we can layer in these extra statistics to go in our favour, to put more probabilities on our side, or ignore them if we care less about having probability, more about just placing loads of trades. Neither way is right or wrong. It's not to say that higher probabilities necessarily means more money, but obviously the higher the probabilities, the less likely you are to have losing trades. So again, you balance that out based on your plan, your thought process, who you are as a person. Okay, so I think that brings me nicely to the end of this. So again, just to recap, you don't have to use AutoClimate. It is a free app, so I think it's a very easy way in many ways for you to help answer question number one. But even if you're watching this and you do something completely different, the first question you should be asking yourself when you trade is, should I buy, sell, or do nothing? Have a consistent, objective way to answer this question, however you do it. Be okay that doing nothing is actually a good thing, because you're not risking money and time for the sake of a losing trade. Why would we do that? And then have something that helps you figure out, are you going to be buying or selling? The more probabilities you put on your side, the more likely it is for a trade to work out in your favour, but the less trades you have, the less probabilities you put on your side, the more trades you have, the less likely they are to work. And again, you decide what way you fall on that, but however you do it, answer this question first. Don't just buy or sell based on something you heard online, or something you read, or something that someone said to you. That's not AutoClimate. So like I said, AutoClimate's a free app. If you go to the link there, tradewithufos.com/Becky, get yourself a free Trade with UFOs membership, and then you can go through from there and download the app. Also, once you've got a free Trade with UFOs membership, like I said before, you can come down and ask me a question through this questions and answers section. which will allow other people, like we see down here, there's other questions there that people have asked in the past. Other people can see the answers to the question. So if you're watching this, maybe recorded, or maybe you are watching it live at the moment, and you think about it afterwards, and you think, oh, hold on, that didn't make sense, or I'm confused about that, or what if this happens, or whatever, I would prefer that you guys ask it here, because then my answer is something that everybody can see, so the rest of the community can learn from it. If you're really, I don't know, nervous, or you don't want to ask a question that's in public, that's fine. You can just email me. It's on the side there, so if you do that, you'll see it. Becky@traddictiv.com, and then you can get your answers from there. So before we round up today, obviously the normal thing that we do on sharpening sessions is we'll do Q&A if you guys have it. Otherwise, we go into a topic. Is there anything for you guys that are watching live now, any questions that you have? Let me know in the chat box. It could be to do with something that we've done today. It could be to do with something else. If I don't have the time to answer the question today, then the next time we do a sharpening session, I'll focus on that. Obviously, you might have questions about AutoClimate that we've gone through already. If you have those kind of questions, again, let me know, and I can. An empty chat box there, which is telling me you're completely new to trading and this is the first thing you've ever seen about something like this. It can seem overwhelming. For some of you that have been trading with Trade with UFOs and you've used AutoClimate for years, then obviously this is just a recap of something you already know. And you could be anywhere in between. It's okay to be confused. That's all done for today. I'll see you guys next time. If you go to tradewithufos.com/live, you'll see the calendar for the upcoming sessions that we have. So you can see on there the next sharpening sessions will be. Come to the next sharpening session. If you have any questions, bring them with you so that we can make sure we cover the stuff that you guys need. Otherwise, again, we'll have another topic that's something we can go into in a bit more depth. Lovely rest of your weekend and a lovely start to the week next week, and we'll see you soon. Take care. Bye bye.